over the last couple of months or so. Vinay Jaising, Vivek, thank you very much for that story. Vivek Jaising is with us, Managing Director, Portfolio Management Services at JM Financial Services. Vinay, good to have you with us here. You've liked the specialty chemical space. We've spoken about that in the past. I don't think you have. I think you had stocks like Archean in your portfolio and maybe a few others. UPL, I'm not so sure, but if you've heard the story and if you want to offer any comments there.
So we do not own UPL. We are a little wary of companies which have a high debt. The higher for longer interest rate syndrome, which is happening in the world, is something which we believe in. So we avoid highly levered companies. Having said that, obviously what UPL is trying to do is reduce its debt. So, as a company, it's doing the right thing. But, we are avoiding this stock for now.
I know IT has been an avoid for you, but increasingly the view is emerging that maybe IT earnings have bottomed out, and at some point of time, 1, 2, 3 quarters down the line, we will see a recovery. But from here on, maybe the downside is limited. Are you in that camp? Have you started looking at stocks outside of Cyient, Axis Cades? I know those were some of your, IT stocks, but have you added on to, your tech portfolio?
Well, not really. We really believe that US's slowdown is here to come. Wait for the next quarter and you'll hear more negative news than positive. If you just see the last week and see the 10-year and 2-year chart of US, both of them, as far as interest rates are concerned, have gone up by 10 to 15 basis points. You're hearing more and more news that, interest rates are not going to be cut in US for a long period of time. Earlier, people had expectations of it being cut in March, April, May. Now that could go, as much as July, August, September. So what that means is there is pain, which would come up in US. The debt in US is just mounting up. The US global debt is north of $34 trillion. The GDP growth is less than the debt growth. So that tells you that there could be pain coming in. And I think that's the reason why, these highly liquid, though well valued, as you rightly said, they're close to the bottom names. We are looking at it virtually every day, but we don't plan to nibble on it currently. We're happy of buying the ER&D names, which have at least a 15 to 20% plus growth. The names you mentioned, both Axis CAD and Cyient, have a 25, 30 and 20% growth respectively on the top line and a similar growth on the bottom line. So we are better off buying, the higher growth stories where we know that both defense and airlines is giving them good contracts.
Okay, all right, got it. So those are some of the IT names and IT themes. Vinay, great to have you on the show today. So I want to talk to you about the sector of the day. And finally, it's large private banks that are leading from the front, and HDFC Bank is seeing plenty of green. But, the question is, A, just tell us about your stance and how you're positioned. And B, whenever FIIs come and they start buying the index and then bank stocks go up, that we know. But I think what I'm trying to understand is what could cause a pivot of domestic money, maybe a bit of a sector rotation, because this is a trade that's been waiting to take off for a very long time. Could it be, good deposit growth this quarter? What's that metric that could perhaps trigger the churn in domestic money towards large cap banks?
So, just before we reach, the trigger for domestic money going to large cap banks, let's see the reason why they haven't gone. And if you look at what's happened in the last year for even FIIs, out of the $25 odd billion which has flown into the country, interestingly, the biggest sector which is gained is not financials, it's capital goods. As much as $5 to $5.5 billion has gone there. A little similar number has gone to the financial space. Now that as compared to a weightage in the index of 30% is clearly much lower. And I think the reason is if you're expecting interest rates to fall in the longer term, let's say 6 months, 9 months down the line, and you're seeing, though the loan book is very, very strong, as you saw in the results or the company data which came out, be it of HDFC or a couple of other names, 20% average number, which is very interesting. Valuations are interesting, but you're seeing deposit growths also increase. The cost of deposits also move up. And that means that, NIMs could get squeezed a little bit. And more importantly, when, interest rates fall down, people will have to mark their loan book or part of their loan book to the repo rate, which means you'll see a yield coming down. You add that to the corporate growth. Today retail India is growing the loan book. Tomorrow, a couple of months forward, when you see the loan book being grown by the corporate India, you'll start seeing margins further go down. So yes, the quality of Indian large cap banks are very solid. Valuations are good. But I think the high growth years are behind them. And now you're looking at 10 to 15% growth on a year-end basis for the large caps. So you would buy them as stable compounders, but you won't go overweight them. And that's exactly what our stance is.
Okay, all right. Hi Vinay, good afternoon and good to see you in. I recall, a few quarters ago, y'all were bang on. Y'all picked up mid-cap cement and y'all got in at very, very low levels. If I remember correctly, Orient Cement was one stock that y'all got in as well, and the stock more than doubled from there. But the last quarter has been a little bit sketchy for all cement companies. And obviously, when there is a bit of a tussle, the smaller ones get hammered even more. So how are you positioned out there right now? Because from your buy price, well, you will be way in the money. But what do you do from now? Some of those stocks have come off 20, 25, 30% as well. So your take on mid-cap cement, and now will you go with the large cap names?
Right. So this is an interesting space. So overall, we use a barbell approach wherein, in at least in NDPM's portfolio, we have over a 50% weightage in small and mid cap and about 40% plus in large cap, and cash being, part of the other thing. So as you rightly said, Mukund, our analyst, got Orient Cement very, very well. Hats off to him. His point was at 5 times EV EBITDA, this stock can go up by 50%, and he went right. Having said that, we also had two other reasons why the mid-cap space did well. One was the prices of coal that was coming down, which meant margins would do well, inventories would go down, which meant margins would do well, and price would go up of cement because of the demand. All of these alluded to better margins, which have happened. But I think when you're looking forward in the cement sector, especially in this quarter, you're actually seeing exactly the opposite. You're seeing the prices of cement have corrected by 3-4%. You've seen coal prices being largely constant, which means that margins could be under pressure. So I think the best of heydays for the cement sector is behind you, but demand growth is going to be robust. So incrementally, the way we are looking at it, it is time to look at large caps over mid caps as we look at cement currently.
You like telecom, you like the entire Make in India play. What manufacturing? What about a stock like Tejas Networks? It's been a big multi-bagger. Have you analyzed it, and is it a part of your portfolio? If it's not, if it is, why? If it's not, why?
Sure. See, the way we look at telecom really is, are you looking at India speaking a lot more? Are you looking at data usage being a lot more? Are you looking at the advantages to have the power to increase your ARPUs and hence, get more pie from the subscriber? And I think all those answers come up in, happens to be a large cap stock, but in Bharti Airtel. So technically that's where we are focused on. If you look at, the company's ARPUs on a 1 year basis, it's gone up by 10%. You look at the overall subscribers, they've gone up by 4%. So technically, if you just multiply the two, you'll see a 13 to 15% top line growth. Yes, there is an Africa problem, but on the longer term, you're seeing incrementally the company being FCF positive due to the deleveraging story. So that's really a simple reason why we like telecom. When you look at telecom infrastructure, and that's where I think other companies come in, including the names you mentioned. What we see here, there is a lot of squeeze in margins which happen, and you got to depend a lot more on government. So if you're playing the Make in India story, let's play the story where you have a story where you're replacing global products, like let's say defense or even railways, where you're playing the domestic growth story. Companies like Tejas Network, at least currently based on our thesis, doesn't fit into either of the two plays. And we see more attractive companies both in the manufacturing / Make in India or the telecom part, which is why we haven't bought that stock.
Got it. All right. Vinay, what about consumer? Now, again, consumer, it's been the same trends continuing for well over a year, right? Discretionary is doing well, whether that is, premium real estate or, you have names like Titan, which are doing really well. And then there are staples, which has kind of fallen by the wayside. I guess similar reasons. You mentioned growth concerns for banks. And then I was thinking, staples aren't giving you anything, just about mid-single digit. So do you see that piece changing at all? And how are you approaching it? What do you like in consumer?
So, consumers, one space where, again, our analyst Anirudh has got it very right. The big issue was the demand overall is not growing as well as expected. So if you were to talk about quarterly results, that's one space which last quarter got the advantage of margin improvement because commodity prices went down, but you didn't see volume growth happen as well as you wanted it to. Apart from a few companies like, let's say, Varun Beverages, which is gaining from, just marriages and parties happening, or companies like hotel industry where you're seeing so much of tourism go up, or even jewelry. You all spoke about gold a little earlier. Gold jewelry is increasing. Apart from these spaces, we are not really looking at the consumer space anywhere else. Maybe another one more name would be a company like a Bikaji, food space again, which is fast moving consumer, where you really buy it, eat it, and incrementally increase your consumption spend out there. But apart from these spaces, the usual consumer names or staples, we think the growth is lacking. Valuations are still not compelling. Yes, they are high rows. Maybe they're like the IT sector, close to the bottom. But when we are looking at India, we are looking at growth in earnings and growth in the market caps. That's where we have a question mark, and we're not touching them.
Vinay, thank you very much for joining in, and we look forward to chatting with you very soon. Need to get into a short break on that note. On the other side, we'll get you a check on what dealing rooms are saying in our segment East Street Chatter. We get you a few BTS